Welcome to the Deep Dive. We take complex corporate updates and really try to make sense of them for you. Today, we're looking at Supermicro Computer, SMCI. They just had their Q1 fiscal 2026 earnings call, and honestly, it's a fascinating picture because, on one hand, the quarter itself, Q1, it missed expectations, revenue was down, but then almost in the same breath, they massively raised their forecast for the whole year. We're talking at least $36 billion.
Yes.
So our mission today is to figure out how both things can be true. How did the recent past look, well, frankly, a bit weak, while the future suddenly looks incredibly bright?
It's a really stark contrast, isn't it? And it really gets to the heart of what's happening in the AI infrastructure build-out right now. Think about the two headlines that came out. First, guidance for Q1 revenue was, $6 to $7 billion. They came in at $5.0. So, okay, that's a miss, a clear miss, but, and this is the kicker, during that same quarter, they booked, get this, over $13 billion in new orders, record orders, including the single biggest deal they've ever signed in their entire 32-year history.
Wow, okay. So yeah, short-term delivery issue hiding just this monumental wave of future demand.
Exactly. You have this execution challenge in Q1 masking an absolutely unprecedented surge in business coming down the pipe.
All right. Let's break down the Q1 results first, the part that looked disappointing. This is for the quarter ending September 30th, 2025. Revenue, like you said, $5.0 billion. That's down 13% from the previous quarter and down 15% from the same quarter last year. Not great on the surface, but I think the real eyebrow raiser, especially for Wall Street, must have been the margins. Non-GAAP gross margin fell hard, down to 9.5%.
Yeah, 9.5%. And just for context, that's 360 basis points lower than the 13.1% they had just a year ago. That's a significant drop.
Huge drop. And even the bottom line, the non-GAAP EPS, earnings per share, came in below guidance at just $0.35. So looking just at those numbers, you might think, oh, demand is softening.
You might, but that's where you have to connect it to the other part of the story.
Yeah.
Management was very clear. They said the $5 billion revenue wasn't because demand dried up. No, the miss was almost entirely, they said $1.5 billion of revenue. That just shifted. It didn't disappear. It just slipped from Q1 into Q2, the current quarter.
Okay, $1.5 billion is a massive shift. What caused that? They mentioned things like configuration upgrades and validation complexity. But, shouldn't a company this experienced in complex hardware manage that better? Why let such a huge chunk slip?
It's a fair point, but I think it highlights just how complex these new systems are. We're not talking about shipping, standard pizza box servers anymore. They're delivering these enormous, custom-built, fully integrated AI GPU racks. Think entire data center building blocks. So when a huge customer, maybe a hyperscaler, says late in the game, actually, we need to upgrade the memory here, or hey, we want to increase the order size by 20%, it resets the clock. The whole integration, the testing, the validation process for that specific massive rack configuration, it has to be redone or extended. It's complex stuff.
So it's like building a custom Formula One car versus, just selling a sedan off the lot. You can't count the sale until it's perfectly tuned and tested for that specific customer.
Exactly. The sheer complexity and the customization involved just stretched out the delivery timelines past the September 30th cutoff for some of these huge deals. The demand was absolutely there. The logistics just struggled to keep up with the last-minute tweaks on these new, very large systems.
That makes sense. And it underlines the sheer scale of what they're trying to deliver.
Yeah.
So what is driving this $13 billion plus order book? What are they selling?
Well, no surprise, it's overwhelmingly AI GPU platforms. That's now over 75% of their total revenue. And the numbers are just pretty wild. Just one product line, the system's based on NVIDIA's Blackwell architecture, specifically the GB300, that alone accounts for over $13 billion in back orders right now.
$13 billion, just for the GB300 systems. It's incredible scale.
It really is. And they're not just a one-trick pony. They're shipping various high-end platforms in volume already. Things like the GB300, NVL72, different HGX B300 systems, RTX PRO, B200, NVL4. Plus, they're ramping up AMD's MI350 and 355X platforms, too.
So a broad portfolio.
Very broad. And what's also interesting is how far ahead they're planning. They're already talking about preparing manufacturing capacity for NVIDIA's next generation, Vera Rubin, and AMD's Helios, which aren't even expected until, calendar 2026?
Right.
They are positioning themselves way ahead of the curve. Time to market leadership.
Okay, this complexity, this need for deep integration, it leads perfectly into the big strategic shift they talk about, right? Moving beyond just selling servers and components, they're really pushing this idea of becoming a total solution provider for the whole AI data center, which brings us to this new acronym they're using, DCB Data Center Building Block Solution.
Yeah, DCBBS is kind of like SMCI version 4.0, you would say. They see themselves evolving from selling parts to selling integrated racks, and now to selling essentially a prefabricated AI factory. DCBBS is designed as this end-to-end rack-scale solution. It's plug-and-play, basically, optimized for the whole data center environment, not just the server itself.
So total solution means more than just the compute and storage. What else is in this DCBBS package?
Oh yeah, much more. It includes the servers and specialized storage, of course. But critically, it includes advanced liquid cooling that's huge for these power-hungry AI chips. We're talking direct liquid cooling, DLC, DLC2 heat exchangers, even things like chiller doors. Plus the power infrastructure, power shelves, battery backup, and then all the networking fabric, the cabling, the management software, and the deployment services to make it all work together seamlessly. It's the whole ecosystem.
Okay, I can see the value prop for the customer. Get your AI cluster online much faster, right? They talked about cutting deployment time dramatically.
Exactly. They're claiming they can shrink the typical time to get it running, time to online, or TTO, from maybe 18, 24 months down to potentially just 12 months in some cases. That speed is gold in the AI race. And simplifying deployment, well, that helps lower the total cost of ownership, the TCO.
Makes sense. Faster time to results, less complexity. But what about for SMCI? Is this push into complex integration, liquid cooling, all that? Is it actually more profitable for them than just selling the hardware?
Now that is the really crucial part of the strategy, and it explains why they seem willing to tolerate these low margins right now. Management believes this DCBBS business, selling the whole integrated data center solution, will be much more profitable long term. They actually threw out a number. They think they can get more than 20% profit margin on this DCBBS product line eventually.
More than 20%. Compared to the 9.5% they just reported, that's more than double.
Exactly. So the bet is endure the pain now. Accept lower margins on the initial high-volume GPU platform sales, make the huge upfront investments in integration and capacity, all to shift the revenue mix over time towards these high-value, high-margin DCBBS deals. It's a major, major strategic pivot.
A massive bet indeed. Okay, so that explains the strategy, but it brings us back to the immediate challenge, scaling up to meet this demand and making that transition happen, which means looking at the Q2 guidance.
Right, and the Q2 guidance is where you really see the scale of the ambition and the immediate cost. Revenue guidance for Q2, the quarter we're in now, is a huge jump, $10 billion to $11 billion.
10 to 11 fitting. That's basically double Q1 in just 3 months.
It's an incredible ramp, and that's what allows them to raise the full year fiscal 2026 guidance to at least $36 billion. If they hit $10 or $11 billion in Q2, that $36 billion starts to look achievable, right?
It does mathematically. But what about the margins? We saw 9.5% in Q1.
Yeah.
Does it get better in Q2 with more volume?
Nope. Quite the opposite, actually. This is where the short-term pain really bites. They're guiding Q2 gross margin to be about 300 basis points lower than Q1.
Lower. So 300 basis points below 9.5%. We're talking somewhere in the low 6% range for gross margin.
That seems to be the implication, yes. Maybe low to mid sixes. It's incredibly thin for the kind of complex product they're delivering.
Wow. Okay. Why are margins getting crushed while revenue is exploding? That seems counterintuitive.
They gave two main reasons. First, they're in the middle of ramping up a brand new mega-scale rack platform. It's optimized for the GB300, tied to one of those huge strategic customer wins. And when you start manufacturing a complex, large-scale system for the very first time, your initial costs are always super high, yields might be lower, processes aren't fully optimized yet, economies of scale haven't kicked in.
Okay, initial production inefficiencies. Makes sense. What's the second reason?
The second one is about market share. They said they are deliberately investing heavily in new customers right now. That means putting extra resources like expensive AI engineers, more support, maybe better initial pricing or service deals up front to win these massive global design contracts for the future.
So they're essentially using low margins on current deals as an investment to lock in customers and secure that future, hopefully higher margin DCBBS business. Buying market share.
Precisely. They're prioritizing growth and customer acquisition over short-term profitability right now. It's a classic hypergrowth playbook, just on an absolutely massive scale.
And to support that $10 billion quarter, that $36 billion year, and that $13 billion backlog, The manufacturing expansion must be just colossal. You mentioned this gigawatt project idea.
Yeah, the scale they're planning is almost hard to grasp. They're literally talking about building capacity in terms of the power their manufactured systems will consume, hence the first gigawatt project framing. This isn't just one factory, they're expanding everywhere. In Silicon Valley, their main hub, they've got a new San Jose Campus 3 coming online. They're looking at new North American sites, possibly Texas or Mexico. And internationally, Taiwan, the Netherlands, Malaysia is already ramping up production, and they even mentioned plans for the Middle East soon. It's a global footprint expansion.
How much actual output capacity does this translate to? Can they physically build enough racks?
Their stated target within this fiscal year is to reach a production rate of 6,000 racks per month, and importantly, half of those 3,000 racks per month are slated to be the complex liquid-cooled DLC racks.
6,000 racks a month? That's huge.
It is, and management even threw out a potential total capacity number if things run smoothly. They said something like the $100 billion range annually. Now, that's likely optimistic peak capacity, but it shows the scale they believe they need to build for. They're not just catching up, they're building for years of growth.
Okay, but building all that capacity, holding all that inventory for $10 billion quarters, that takes an enormous amount of cash, right? Especially when your margins are so low. We have to talk about working capital and cash flow.
Absolutely critical point. And yes, the strain was very visible in the Q1 results. Cash flow used in operations was negative $918 million.
Nearly $1 billion burned in operations in one quarter. Ouch.
Yeah. It shows the cost of preparing for that massive Q2 ramp. Look at inventory. It jumped from $4.7 billion at the end of Q4 to $5.7 billion by the end of Q1. They had to buy all those expensive GPUs and components before they could ship the final systems and get paid.
So they're fronting the cost.
They are. And they clearly recognize this cash crunch was becoming a bottleneck. That's why, pretty smartly, they secure a new $1.8 billion accounts receivable, or AR, financing facility.
So borrowing against the money customers owe them.
Essentially, yes. It gives them immediate cash based on those receivables, improving their working capital flexibility. It's proof that right now, managing cash is just as vital for them as sourcing chips. They need the cash to fuel the growth engine.
What an incredible story unfolding here. It really is growth at almost any cost in the short term, isn't it? Spend the cash, sacrifice the margin to capture this massive AI wave.
That sums it up perfectly, I think. You can see the entire strategy reflected in the financials. SMCI is consciously driving through this period of really low profitability, the low gross margins, the huge inventory build, the negative operating cash flow. It's all part of the plan. They see it as necessary pain to solidify their position as a leader, maybe the leader, in building these next-gen AI factories, these DCBBS solutions. They're proving they can deliver at scale for the biggest players in the world.
And management certainly sounds confident. You hear phrases like super excited, and they believe that $36 billion full-year guidance is actually very conservative. They expect growth from both continued GPU demand and this ramp in the higher-value DCBBS solutions kicking in. So here's a final thought for you listening to this. You heard the company explicitly say they will manage their growth based on cash flow availability. We just talked about that huge negative cash flow in Q1, the ballooning inventory, the need for that big AR facility. The question is, how fast can SMCI really keep accelerating past that already huge $36 billion target? They've mastered the hardware supply chain, arguably, but the real constraint to watch, the core trade-off over the next few quarters, it isn't just about technology, it's financial. How long can they sustain this pace on borrowed cash and thin reserves before maybe, just maybe, they have to tap the brakes slightly to rebuild the balance sheet? That's the tension to keep an eye on.